A lot has landed since the last video, and the global market picture has moved with a speed that should make every investor pause. The lead story today is that the CME has suddenly cut margin requirements across the board. Gold futures were trimmed from 9% to 7%, and silver margins were slashed from 18% down to 14%. This follows 6 consecutive margin hikes during the recent metals run, 6 increases that were specifically designed to squeeze out leverage and crush participation. Now, right as registered inventory sits at critical lows and squeeze pressure is at its highest point in years, they make it cheaper to play in this market again. Why now? The timing of a 22% reduction in silver margins deserves intense scrutiny. Exchanges raise margins to cool a market and shake out weak hands. It worked. Open interest crashed and volumes fell. But now, with silver draining at a rate that should be front-page news, they are inviting the paper traders back in. Either they are trying to provide liquidity to a dying market, or they are making it cheaper to hold massive short positions while the physical squeeze risk is highest. But here is the open loop that reveals the true state of the vault. While the CME was busy cutting margins, the Wednesday report dropped a bombshell. 6 million ounces of registered silver were adjusted out in a single session from 7 different custodians simultaneously. We are talking about Asahi, Brinks, CNT, Delaware, HSBC, Loomis, and StoneX. Registered silver has fallen from 87 million to 81 million, 235,000 ounces since this morning. The rate of drain isn't just steady, it is accelerating. But why are the world's largest banks suddenly pulling their deliverable metal off the exchange at the exact same moment it becomes cheaper to trade paper? The answer involves a 2-decade low in managed money that is about to collide with a 133-to-1 leverage ratio that the system can no longer hide. Managed money silver longs are currently at a 2-decade low. Think about that. Silver moved from roughly $30 to over $120 in this cycle, and yet money managers cut their long exposure by 70% through that entire move. At the same time, the physical silver market has been in a structural deficit for 5 consecutive years. This is not a contradiction. It is a setup. The paper-to-physical disconnect has been building for years, and it does not fix itself overnight. To understand the scale of this distortion, look at the gold side. For every single ounce of physical gold in deliverable form, there are 133 ounces of paper gold trading against it. That is a leverage ratio of 133 to 1. The next time you see a sharp sell-off and wonder why physical prices didn't move, that is your answer. Paper can reprice violently when it is over 100 times the size of the underlying asset. But here is the open loop for the early bird traders. For 4 consecutive trading days this week, gold has sold off sharply at exactly 8 o'clock in the morning Eastern Time. Monday was down 3%, Tuesday was down 4%, and the pattern continued through Thursday. $4 trillion in paper gold value was wiped in 4 sessions, all triggered at the identical minute with the same mechanical signature. This is not natural selling. It is an algorithm. It is the same timing structure that appeared in Bitcoin for months before it was forced to stop. Who is behind the 8 a.m. dump, and why does one specific firm's name keep coming up in the trade logs? We are about to look at the global net inflows that prove institutional money is actually running into gold, even as the 8 AM Algo tries to burn the house down. While the 8 AM algorithm is busy wiping out trillions in paper value, global gold ETFs saw net inflows of $5.3 billion in February alone. This marks the 9th consecutive month of inflows and the strongest start to a year on record. Total global assets in gold ETFs have climbed to a record $71 billion. The institutional money is not leaving, it is accumulating. The paper price is being moved by a machine, while the physical and fund-backed markets are being swallowed by real capital. Those who understand this distinction are positioned differently from those who just watch the flickering red numbers on a screen. Now look at silver. Western spot is at $82, but Shanghai spot is at $93, and Shanghai futures are at $95. That is an $11 premium that survived the paper sell-off. The DXY dollar index is consolidating right now, waiting for the Non-Farm Payrolls, or NFP, data. But here is the open loop for the geopolitics of this trade. While we wait for a jobs report, the war in the Gulf has moved from a backdrop to the primary variable. Iran just launched its 20th wave of strikes, targeting U.S. and Israeli positions with ballistic missiles and drones. Russia has now stepped in, stating they will do everything possible to make a military operation against Iran impossible. Israel is losing $3.7 billion per week. Kuwait has suspended oil refining. The Strait of Hormuz is closed. We are about to look at the mathematical trap the Pentagon is facing, where a $20,000 drone is being intercepted by $20 million worth of Patriot missiles, and why the market's short war assumption is about to be shattered by a timeline that now stretches into next year. The math of this conflict is moving in a terrifying direction for the West. In just 6 days, $5.4 billion was spent on intercepts. That is 26% of Iran's entire annual military budget, gone in less than a week. The US and Israel are reportedly considering reducing their attack frequency, simply because they are running out of weapon stocks. A $20,000 drone is being traded for a $20 million Patriot missile. The math doesn't work. Now look at the Pentagon's shifting timeline. First, they said days, then 4 weeks, then as long as needed. Now the briefing documents are talking about operations through September. This war has been repriced 4 times by the people running it, and each time the duration gets longer and the cost explodes. The markets are still trying to price a short, successful outcome, but they are ignoring the historical pattern. When a conflict gets repriced from short to long, stocks and the dollar drop, while oil and gold scream higher. But here is the open loop for your wallet. Every $10 move higher in oil adds approximately 20 basis points of inflation pressure. Oil has already moved from $55 to over $80. That's 50 basis points of inflation already baked into the system, pushing estimated CPI toward 3%. Brent oil closed at $85 today. WTI is at $81. If we hit $95, you are looking at a 3.2% inflation rate that makes a mockery of any perverting pivot narrative. Kuwait is offline. Hormuz is under pressure. We are about to reveal a shocking report that the U.S. Treasury is now considering a direct emergency intervention in the oil futures market to hide these rising costs. If they are willing to step into the oil pits to manipulate the price, what are they doing to the silver market at 8 o'clock every morning? The report that the United States Treasury is considering intervening in oil futures to control the price should tell you everything you need to know about free markets. In 2026, a government openly discussing price control in a futures market is the ultimate admission that the system is breaking. If they are doing it in oil, you can be certain the silver and gold futures have been under similar supervision for years. The ones who have been called conspiracy theorists for a decade aren't wondering anymore. The data is doing the talking. However, let's look at the bear case with intellectual honesty. Silver did pull back to $80 before recovering to $83, but the lower time frames are still technically weak. The dollar is consolidating before the NFP report, and that resolution can go in either direction. If the DXY breaks the January 15th level, paper metals face significant more downside. The CME margin cut might simply be a way to make it cheaper for paper shorts to pile in before a major data release. With open interest at decade lows, participation is thin, meaning a small amount of volume can move the price sharply in either direction. The CME margin cuts go into effect after the close today. This is the margin trap. By making it cheaper to hold positions right before a high-impact news event like the NFP, the exchange is inviting maximum volatility. If the jobs number is a surprise, the thin participation in the market will lead to a flash move that could wipe out anyone using the newly lowered margins to overleverage. Do not trust the lower margins as a signal to buy. Trust them as a signal that the exchange expects a violent move. Long-term stackers, your job hasn't changed. You watch the lease rates, you watch the delivery notices, and you watch the 6 million ounce overnight drain. The paper market is still arguing, but the physical market already knows where this is going. Silver at $83 in New York versus $95 in Shanghai is a gap that will eventually be closed by the movement of physical metal, not by the printing of more paper. If you are a short-term trader, stay on the sidelines. The tape is choppy, directionless, and whipsawing on war headlines that change by the hour. Sidelines are not weakness. In a minefield, they are the only edge you have. The January 15th level on the DXY is the line in the sand. If the dollar stays below it after the payroll data, the paper shorts are in a world of pain. But here is the final open loop before we head into the weekend. There's a growing rumor that one of the 7 custodians who lost metal overnight did not adjust the metal out. It was seized as part of a national security reserve order. If a Western government has started seizing private vault stocks to cover their own industrial deficit, the paper market is already dead. We will be tracking the custodian filings the second they hit the wire on Monday. Invest with logic, not hype. OG out and about. But here is the open loop that makes the paper slam irrelevant in the long run. While the paper traders are arguing over a jobs report, the Shanghai Gold Exchange withdrawal data is running 3 times higher year over year. 3 times. That isn't a seasonal anomaly. That is a physical drain that the Western paper markets literally cannot sustain. We are about to reveal the final margin trap. And the reason why tonight's close is the most important session for silver in the last 5 years, involving a rumor of a massive national security seizure at a major Western vault.